Most traders think their problem is discipline. They believe if they could just force themselves to follow the rules, everything would fall into place. But that belief is the very trap keeping them inconsistent. Because discipline doesn't eliminate fear. Discipline doesn't dissolve hesitation. Discipline doesn't silence the voice that panics when the market moves against you. Those emotional reactions don't come from a lack of willpower. They come from the internal beliefs you're projecting onto the market. Beliefs about danger, about being wrong, about losing, about not being good enough. And as long as those beliefs remain active, the market will trigger them over and over again, no matter how disciplined you try to be. The real breakthrough begins the moment you stop trying to control the market and start working on the only thing you can control, your perception of risk. When you learn to think in probabilities, when you stop expecting the market to make you right, when you genuinely accept that anything can happen, then the emotional charge disappears. Then discipline is no longer something you fight for. It becomes automatic, effortless, natural, because consistency isn't the result of discipline. Consistency is the result of a mindset aligned with market truth. And once you align your beliefs with that truth, the market stops being a battlefield. It becomes a place of limitless opportunity, free of fear, free of hesitation, and free of the emotional chaos that has held you back. Today isn't about trading harder. It's about thinking differently. And when your thinking shifts, everything in your trading changes with it. Discipline is often held up as the golden solution to every trading problem. When traders feel emotional, impulsive, inconsistent, or unstructured, they turn to discipline as if it were a magic cure. They try waking up earlier, repeating affirmations, following stricter rules, forcing themselves to obey their plan, or promising to be better tomorrow. But the truth is far less comfortable. Discipline cannot eliminate emotional trading, because discipline does not touch the origin of those emotions. Emotional trading is not a behavioral problem. It is a belief problem. You cannot discipline your way out of a mindset that is fundamentally misaligned with the nature of uncertainty, and the markets are pure uncertainty. If your beliefs about uncertainty are flawed, your behavior will inevitably collapse under pressure no matter how disciplined you attempt to be. Most traders misunderstand what drives their emotional reactions. They think the emotions arise because they failed to follow a rule or made a poor decision. But in reality, the emotion happens before the decision. The decision is merely the expression of an underlying belief system that has been triggered by market activity. When a trader feels fear, hesitation, anxiety, greed, or euphoria, those emotions are not messages from the market. They are messages from the trader's internal world. The market merely acts as a mirror, reflecting back the meaning the trader has attached to price movement. And meaning is rooted in belief. If you believe losing is painful, threatening, or defining, then every tick against your position will trigger fear. No amount of discipline will stop that from happening. You cannot discipline yourself into feeling safe when your beliefs tell you that you are in danger. Most traders try to attack emotional trading from the surface. They think in terms of behavior: I need to follow my rules, or I need to stop overtrading, or I need to cut losses faster. These are all behavioral goals. But behavior is only the end result of a process, not the starting point. The starting point is belief, the mental framework you bring to the market. If you believe you must be right to succeed, uncertainty will feel threatening, and you will react emotionally whenever the market behaves differently than your expectation. If you believe losses are failures, you will cling to trades, avoid cutting them, and treat every red candle as a personal attack. If you believe winning validates your worth, you will chase trades, over-leverage, and force outcomes. Discipline cannot fix these patterns because the emotional charge driving them is still active. Trading is the art of managing uncertainty, yet most traders have beliefs that resist uncertainty. They want certainty, direction, reassurance, and predictability. They want the market to behave, to justify their entries, to reward their patience, to confirm their biases. These desires create emotional tension because the market owes none of that. When reality contradicts expectation, the trader experiences psychological friction, and that friction manifests as emotion. Discipline cannot resolve this friction. You cannot will yourself to ignore the conflict between what you expect and what the market delivers. You must change the expectation itself. In other words, you must shift the belief. Consider a trader who believes deep down that a winning trade means they are skilled, and a losing trade means they are incompetent. That trader carries their identity into every position. This creates fear, pressure, and emotional attachment. Every fluctuation feels personal. The market becomes a judge, not an auction. How can discipline help this trader? They can try to follow rules, but under pressure, their emotions will hijack them. They will hesitate to enter because they fear being wrong. They will exit early because they fear missing the win. They will hold losers because they fear admitting failure. Their actions are controlled not by a lack of discipline, but by beliefs they have never examined or changed. Shifting beliefs about uncertainty means internalizing a new truth. Anything can happen. Not as a phrase to repeat, but as a deeply integrated understanding. When you truly accept that anything can happen, you stop requiring the market to confirm your expectations. You stop expecting a trade to work simply because you took it. You stop needing an outcome to validate your identity. You begin to see the market as a field of probabilities rather than a test of your worth. This belief shift dissolves the emotional charge because your expectations are aligned with reality. And once your expectations match reality, there is no longer any internal conflict for discipline to fix. Traders often misunderstand acceptance. They think they have accepted risk, but they haven't. They may intellectually understand the concept, but emotionally they are still resisting uncertainty. Acceptance is not an idea. It is a belief-level transformation. You know you have accepted uncertainty when you can enter a trade without needing it to win. You know you have accepted uncertainty when you can take a loss without emotional backlash. You know you have accepted uncertainty when the market no longer threatens your sense of self. At that point, discipline becomes effortless because you are no longer fighting your own emotional resistance. You are simply executing your edge. Most emotional trading occurs because the trader has not reconciled the difference between the market's randomness and their desire for control. When you try to control something uncontrollable, frustration is inevitable. When you try to enforce discipline on emotional resistance, you create an internal war. The more you force, the harder you collapse. You don't need more discipline, you need fewer internal contradictions. You need beliefs that allow you to operate in an environment where anything can happen without feeling threatened by it. Shifting your beliefs also transforms how you perceive loss. Most traders subconsciously believe losses are bad, dangerous, painful, or negative. These beliefs amplify emotional reactions, but when you adopt the belief that losses are simply the cost of doing business, a neutral expense necessary for long-term profitability, your emotional response changes. Losses no longer feel like punishments or failures. They become data points, neutral pieces of information. When losses lose their emotional charge, discipline is effortless because there is no fear to override your rules. Another belief shift involves detaching from the need to be right. Traders with a need to be right belief system will always struggle with discipline. Why? Because following rules becomes secondary to proving themselves. They will break rules to protect their ego. They will move stops, add to losers, or avoid taking valid trades, all to avoid feeling wrong. When you change the belief from, "I must be right," to "I only need a probabilistic edge," everything changes. Suddenly, being wrong is no longer a threat, it is simply part of the game. This belief removes the psychological friction that creates emotional trading. Beliefs about market behavior also matter. Many traders carry hidden assumptions, such as the market shouldn't reverse here, or it's due for a pullback, or it has to break this level. These beliefs impose personal logic onto a system that operates independently of human expectation. When the market behaves differently, the trader feels shock, frustration, or panic, not because the market is irrational, but because the trader's beliefs are unrealistic. Shifting beliefs to align with market truth, seeing price as neutral, random and short-term movement, and shaped by countless participants, removes these emotional triggers. When you no longer expect the market to behave a certain way, you no longer react emotionally when it doesn't. Once beliefs shift, discipline is not something you struggle to maintain. It becomes the natural expression of a mind no longer fighting itself. A trader with aligned beliefs does not need to force discipline because their emotions no longer interfere with execution. They follow their rules because nothing inside them resists following those rules. The internal battle is over. Their behavior becomes consistent because their beliefs support consistency. The transformation from emotional trading to confident, rule-based execution is not a matter of willpower. It is a matter of belief alignment. When you change your beliefs about uncertainty, risk, loss, and randomness, your entire trading experience changes. The market stops being a battlefield and becomes a flow of opportunity. You no longer react, you observe, you no longer fear, you accept, you no longer chase, you execute. This is why discipline cannot fix emotional trading. Discipline attacks the symptom, but belief shift attacks the cause. When your beliefs align with the true nature of the market, emotional trading dissolves naturally, effortlessly, and permanently. Only then can discipline become what it was meant to be, not a force you must apply, but a reflection of the trader you have become. The market itself is neutral. It does not think, it does not judge, it does not reward or punish. It has no awareness of you, your goals, your hopes, or your fears. Yet traders often feel as though the market is doing something to them, hurting them, teasing them, punishing them, or intentionally moving against them. They feel anger when price reverses, fear when it spikes, regret when they exit early, and excitement when it moves in their favor. But the market is not creating those emotions. The emotions originate from the trader's internal world, from unexamined expectations and deeply rooted assumptions that clash with what the market actually does. When your expectations and market reality collide, emotions erupt. This is the core of emotional trading. Every emotion you feel while trading is connected to a belief you hold about what the market should do. However, the market has no should. It moves based on the actions of millions of participants, each with different motives, timeframes, and perceptions. It is fundamentally unpredictable in the short term, but traders, without realizing it, bring rigid expectations to every trade. They expect a breakout to continue. They expect a pullback to reverse at a specific level. They expect a trend to persist. They expect a candle pattern to behave exactly like it did in the past. These expectations give them a sense of control, but they also set them up for emotional distress. When the market fails to meet these expectations, as it often does, the trader experiences disappointment, frustration, fear, or confusion. The emotion is not caused by the market's movement. It is caused by the collapse of the trader's expectation. Consider what happens when a trader enters a long trade, expecting price to move upward. The expectation itself carries emotional weight. The trader is not just observing the market, they are projecting a desired outcome. As soon as the trade moves against them, negative emotion arises, not because the market is dangerous, but because reality is not matching the expectation. If the trader had no expectation, if they truly believed that anything can happen, the movement against them would carry no emotional charge. It would simply be seen as one of many possible outcomes, neutral and impersonal. Instead, it feels like a personal attack because the trader expected the market to behave in a way that made them comfortable. Unexamined expectations create emotional dependency on the market. Traders begin to depend on the market to validate them, to reward their decisions, to confirm their predictions, or to soothe their doubts. They become emotionally attached to outcomes without even realizing it. They expect the next trade to make back the last loss. They expect winning trades to run. They expect confirmation signals to work exactly as they did in backtesting. Every layer of expectation increases emotional vulnerability. When the market fails to deliver the expected result, no matter how logical the expectation may seem, the emotional reaction is instant. The disappointment is automatic because the trader had already mentally spent the reward of the expected outcome. The most destructive expectations are the unconscious ones. These are the beliefs traders carry from past experiences, personal identity, fear-based thinking, or conditioned assumptions. A trader who grew up being punished for mistakes may unconsciously treat losses as failures, making them feel shame or anxiety when a trade goes red. A trader who has tied their self-worth to performance will feel panic when a trade threatens their identity. A trader who believes success must be earned through effort may expect the market to reward them simply because they worked hard, analyzing the setup. None of these expectations have anything to do with the market. They are internal narratives projected onto a neutral environment. And because they go unexamined, they wield tremendous emotional power. Expectations also cause traders to interpret market movement through a biased lens. Instead of reading what is actually happening, traders often see what they want or fear to see. A small retracement may look like a reversal if the trader fears losing. A choppy range may appear like a trending setup if the trader is desperate to enter a trade. This biased perception leads to distorted decision-making, and when the trade doesn't play out as imagined, the trader again blames the market. But the market did nothing wrong. It was the trader's expectation that created an illusion, and when the illusion broke, the resulting emotional pain felt like an attack. The solution is not to eliminate expectations entirely, because you cannot trade without anticipating outcomes. The solution is to transform the nature of your expectations. Instead of expecting specific outcomes, you adopt probabilistic expectations. Instead of expecting certainty, you expect variability. Instead of expecting the market to fulfill a personal narrative, you expect it to behave independently. When your expectations align with the nature of uncertainty, emotions lose their grip, because nothing the market does contradicts your mental framework. This shift begins with accepting that every trade is uncertain, not intellectually but emotionally. Most traders say they accept risk, but their behavior proves they don't. They still react emotionally when the market moves unfavorably because, deep down, they expected the opposite. True acceptance means entering each trade without needing any specific outcome to be okay. It means allowing price to move freely without attaching fear, hope, or resistance to its movement. When you no longer place personal meaning on the outcome of one trade, you free yourself from emotional pressure. Another key belief shift involves recognizing that no single trade matters. Traders often expect each trade to be significant, to fix their account, to restore confidence, to recover losses, or to prove their skill. This expectation inflates the emotional stakes. When everything rides on one trade, even a small fluctuation can trigger panic. But when you view each trade as a tiny, insignificant event within a long series, emotions soften. You no longer expect a single outcome to carry unrealistic weight. You stop projecting desire onto the market and begin to operate from a place of neutrality. Expectations also influence how traders handle randomness. Many traders expect patterns to replicate perfectly. They expect setups to behave consistently regardless of context. They expect indicators to signal accurately every time. When randomness breaks these patterns, and randomness always will, emotional turmoil follows. The trader feels betrayed, confused, or angry because reality diverged from their internal model. By embracing randomness as an inherent part of the game, you remove the emotional shock of unexpected movement. You no longer expect the market to behave predictably, so when it doesn't, there is no emotional disruption. Even positive emotions stem from expectations. Excitement during a winning trade arises because the trader expects the win to continue. Euphoria appears when the trader expects bigger profits. These positive emotions soon become dangerous because when expectations inflate, fear rises alongside them. The trader becomes afraid of losing what they expect to gain. When the market reverses, panic sets in. This shows that even pleasant emotions are rooted in expectation, and thus can lead to emotional instability. To dismantle unexamined expectations, you must become aware of what you bring to the market internally. Every belief you hold about being right, about loss, about reward, about control, about prediction, and about market behavior influences your emotional state. When these beliefs remain unconscious, they control you. When you bring them into awareness, you can evaluate them. You can ask, is this belief aligned with the reality of uncertainty? If the answer is no, you release it and replace it with beliefs that support neutral, probability-driven thinking. The moment your expectations shift from certainty to probability, from control to acceptance, from rigidity to flexibility, emotional trading begins to dissolve. The market no longer threatens you because you are no longer demanding anything from it. You are no longer expecting specific outcomes that the market never promised to deliver. Instead, you are observing, responding, and executing based on what the market is offering, not what you want it to offer. In this state, emotions lose their intensity. They become background noise rather than controlling forces. Ultimately, the market is a canvas onto which traders project their internal world. If your beliefs are fear-based, the market will appear threatening. If your expectations are rigid, the market will appear chaotic. If your identity is tied to outcomes, the market will feel judgmental. But when you align your expectations with market reality, the market becomes neutral. It becomes a flow of opportunities, not a source of emotional pain. The market is not the cause of your emotional reactions. The cause is the unexamined expectations that shape how you interpret market movement. When you change those expectations, you change your entire emotional experience of trading. Consistency in trading is one of the most misunderstood goals in the entire trading world. Most traders chase consistent results through techniques, strategies, indicators, or discipline. They believe consistency is a function of perfect execution, perfect analysis, or perfect timing. But none of these are the true source of consistent performance. Consistency begins and ends with your mental framework, your internal map of how the market works and how you relate to it. When this internal framework is misaligned with how the market actually operates, your trading will always be inconsistent, no matter how skilled you are technically. When your mental framework aligns with market reality, consistency emerges naturally, effortlessly, and sustainably. Market reality is simple but deeply counterintuitive. The market is uncertain, probabilistic, and driven by collective human behavior. It has no obligations, no moral compass, no fairness, and no inherent logic beyond supply and demand. It moves because participants decide to buy or sell for reasons that have nothing to do with your analysis. It is chaotic in the short term, structured in the long term, and unpredictable in the moment. For many traders, this reality is deeply uncomfortable. They want predictability, order, certainty, validation, and a sense of control. They want the market to behave according to their rules, their analysis, their indicators, and their timing. When the market deviates from these expectations, as it inevitably will, emotional friction arises, and consistency dissolves. Consistency in trading is not about controlling outcomes. It is about aligning your beliefs with the uncontrollable nature of outcomes. It is about adopting a mental framework that does not resist the randomness of the market but works harmoniously with it. Most traders lose money not because they lack a strategy, but because their mental framework contradicts market truth. They believe successful trading requires being right, avoiding losses, predicting direction, or mastering control. These beliefs generate emotional tension, distorted perception, and impulsive behavior. A mind that wants certainty cannot navigate a probabilistic environment consistently. A mind that resists loss cannot execute opportunities that inherently require risk. A mind that seeks validation from the market cannot remain objective. Consistency emerges when you adjust your expectations and beliefs to match the nature of price movement. Instead of expecting to know what the market will do, you expect variability. Instead of trying to avoid losses, you accept them as a normal cost. Instead of needing to be right, you rely on probability. Instead of chasing outcomes, you execute your edge repeatedly. When your mental framework is built on these principles, your actions stop conflicting with market behavior. You stop fighting reality, and the market stops triggering emotional reactions. This alignment is what allows consistency to emerge. One of the core elements of a consistent mental framework is genuine risk acceptance. Most traders say they accept risk, but their behavior reveals that they do not. They tighten stops after entry, hesitate to execute, take profits too early, or avoid taking losses. These actions show a hidden belief that risk is dangerous, that losses are failures, and that uncertainty must be controlled. When your mind sees risk as a threat, your behavior becomes defensive, reactive, and emotionally driven. Consistency requires a completely different relationship with risk. You must see risk as neutral, unavoidable, and simply part of the game. When you truly accept that losses are normal, you no longer overreact to them. You no longer avoid taking trades. You no longer cling to outcomes. This shift alone creates massive consistency because it removes emotional interference. Another crucial aspect of aligning your mental framework with market reality is understanding randomness. Price movement is random in the short term. Nothing happens because it should. Even the most perfect setup can fail, and even the worst setup can succeed. When traders expect patterns to repeat exactly or indicators to behave identically, they are operating from an illusion. They have created a mental model in which the market is predictable. This model constantly collides with randomness, creating frustration, confusion, and impulsive behavior. But when you understand randomness and accept it as part of every trade, you stop reacting emotionally when the market behaves unpredictably. You stop searching for certainty where none exists. You start focusing on probabilities rather than perfection. This is the pathway to consistency. Consistency also comes from mental neutrality. Emotional neutrality is not about eliminating emotions, but about removing emotional significance from individual outcomes. When you see each trade as just one of many, as a neutral event in a long sequence, you detach from the emotional highs and lows that destroy consistency. Most traders become inconsistent because they give too much emotional meaning to single outcomes. A win inflates confidence. leading to overtrading or oversized positions. A loss shatters confidence, leading to hesitation or revenge trading. Emotional volatility leads directly to performance volatility. But when your mental framework treats each trade as a probability event with no emotional weight, your actions become steady and disciplined naturally. To align with market reality, you must also embrace uncertainty. Most traders think they accept uncertainty, but internally they resist it. They want confirmation, signals, guarantees, or reassurance. They wait for perfect setups. They fear missing moves. They fear entering early or late. All these behaviors stem from an internal resistance to uncertainty. But the market is uncertain by nature. When you resist that truth, you create internal tension, and that tension expresses itself through inconsistent behavior. When you embrace uncertainty, when you understand that uncertainty is not a danger but simply the environment you operate in, your actions become fluid and adaptable. You stop hesitating. You stop forcing trades. You stop overanalyzing. You act with clarity. Another key component of alignment is letting go of the need for control. Traders often try to control outcomes by micromanaging trades, modifying stops, adjusting positions, or jumping in and out at random. This behavior comes from a mental framework that believes outcomes can be controlled through willpower. But the market cannot be controlled. The only control a trader has is over their actions, entries, exits, risk, and execution. When you stop trying to control what cannot be controlled and focus only on your controllable actions, consistency becomes automatic. Your energy shifts from fighting the market to following your plan. A mental framework aligned with market reality also recognizes that probability is the foundation of consistency. No edge works all the time, but an edge executed consistently over many trades produces consistent results. Misaligned traders focus on short-term outcomes. They judge their system by the last trade. They panic when a few losses occur. They change strategies constantly. This inconsistent belief system creates inconsistent results. But when you adopt a probabilistic mindset, you understand that wins and losses are distributed randomly across a large sample. You no longer judge your performance by single trades, but by long-term metrics. This mindset frees you from emotional reactions and anchors your behavior in rational execution. Consistency also requires redefining what it means to be right. Most traders equate being right with predicting direction correctly. They take losses personally. They treat wins as validation. This creates emotional pressure that destroys consistency. When you shift your mental framework from "I need to be right" to "I need to execute my edge," the pressure disappears. Consistency arises not from prediction, but from execution. When you no longer attach your identity to outcomes, you perform without emotional interference. Finally, consistency emerges from self-awareness. Many traders act on impulses, biases, fears, and desires without understanding their own psychological patterns. They do not know why they behave inconsistently because they have never examined their thinking. A mental framework aligned with market reality requires self-awareness, knowing your triggers, understanding your emotional tendencies, recognizing your biases, and correcting them. When you develop this awareness, you no longer act blindly. You act deliberately and consciously. In the end, consistency is not built through effort, discipline, or strategy alone. It arises from alignment. When your beliefs, expectations, and mental framework match the true nature of the market, your behavior stops conflicting with reality. You stop fighting uncertainty. You stop resisting losses. You stop chasing outcomes. You operate in harmony with the environment. And when your mind is aligned with reality, consistency is not something you struggle for. It is something that naturally emerges from the way you think, perceive, and act. Consistency in trading isn't earned through force, discipline, or flawless execution. It's born from mental alignment with how the market actually works. When you release the need for certainty, accept risk as normal, embrace randomness, and think in probabilities, the emotional friction disappears. You stop fighting the market, and your actions flow naturally from clarity rather than fear. In that alignment, consistency becomes effortless, because your mindset, your expectations, and the market's reality finally match.